All right. So let's take a look. There we go. All right, so let's take a look at Chapter 8. I kind of warned you a little bit last time that it's like Chapter 8 feels really weird, okay? But remember, the one main focus about Chapter 8, because I'm not going to let you forget Chapter 1. If you go all the way back to Chapter 1, you remember there was this concept called the matching principle, right? And if we're going to show X number of dollars in revenue, then we have to show all the expenses associated with earning those revenues, okay? So when we're looking at an issue like that, what we're trying to accomplish in Chapter 8 is that if we sold, and keep in mind, Chapter 8 is basically all about selling on credit, and it is not about a credit card. So throw that out. Remember that when we're dealing with business-to-business transactions, right, typically what's happening there is that the business that is doing the selling is offering, call it in-store credit to the other company. So you've maybe applied to my company and you want to buy some product from me, but you want to be able to buy it on credit. So I run your credit score. I run, the credit scores of all your owners. I want to see how your financial statements are doing. I want to see your cash flow statements. I want to see all that kind of stuff and everything to be able to determine how much credit am I going to offer you. Am I going to offer you $1,000 maximum credit, or am I going to offer you $5,000 or $25,000? Okay, so that's what we're talking about in Chapter 8 is sales on credit. Well, here's the deal. When we make sales on credit, we never intentionally sell to someone that we, don't think is going to pay, okay? But sometimes this kind of stuff happens. I think we've already talked about the fact that it's like as soon as COVID hit, bam. If you were a restaurant supplier, all those restaurants that you sold product to before COVID hit now have very little cash flow, if any at all, and depending on how big they were and how quickly they adapted and everything else, they may be in serious problems, okay? And that's the kind of thing that we're looking at. So if we sold to them, okay, then we're going to have an issue with them paying, okay? Now, at the point where we make the sale, again, remember, we never intentionally sell to somebody that we don't think is going to pay. That would just be crazy, okay? But once we sell to them, based on experience over X number of years that we've been in business, we can sort of start to predict how much is not going to be collectible. Whether it's a 0.5%, 1%, 1.5%, and God forbid, maybe it's 5%. But there's some element there where based on our experience and based on data analysis, we can start to predict these types of things in the future, okay? But understand that when we determine that, we have to make an estimate, and that's when it hits the income statement. In the period in which we make the sale, we make the estimate, and that's when it hits the income statement. That feels really weird because what we want to do is we want to figure out in the future, when we figure out who's not going to pay and exactly how much, we just want to write it off then. And we can't do that, not with financial statements. The Internal Revenue Service allows us to do that because Internal Revenue Service is like, we don't do guessing at the Internal Revenue Service, okay? So the Internal Revenue Service will allow that. Financial statements, not so much, okay? So there's the intro, all right? So what are the trade-offs, okay? Well, here's the thing. There is actually a number. Does anybody have any idea if let's say that we have a small business, and at least initially, the only thing that we were offering for our medium of exchange was cash. That was it. No debit cards, no credit cards, no nothing. And then suddenly we decide, okay, we need to grow this business. And we just implement the process of accepting credit cards, or call it extending credit. How much do you think, percentage-wise, how much do you think that your sales are going to go up? Not that much. It's more like 15%. Okay? So it's not a huge amount, but is it material? You remember materiality from chapter 1? Yes. 15% increase in revenues. That is material. Okay? So it does increase the seller's revenue. They don't tell you that whole 15% thing in the chapter. Okay? Now, but keep in mind, our revenues are now going to go up by 15%, but think about what just happened. Number one, this whole thing about increased wage costs. That sounds a little silly, but remember, now our accounts receivable clerk has to start making calls, phone calls, and we actually need an accounts receivable clerk. Because if we're only doing cash transactions, that's actually kind of easy. Okay? But if we have to have somebody who's actually getting the billing together and monitoring collections, we now have an increase in wage. The other thing is by default, we're going to have bad debt costs. So understand this. If we're only taking cash and we have bad debt, basically that we're saying that somebody is going to give us a counterfeit dollar or 20 or 100, right? And that would be bad debt under a cash system. But this one, now we're talking about somebody's going to come in, somebody's going to buy something, and sometime later they're going to have some financial difficulties and they're not actually going to be able to pay us. Okay? And then the other thing, which is my favorite, is this delayed receipt of cash. So think about what's happening here. If we are in basically a cash basis system, right, which is where most companies start, okay? So we start, we start in business. Every single time we make a sale, we get cash coming in. Well, that's actually pretty easy because the cash flow actually matches the income, which basically means if we bring in $20 and then we have to pay out X number of dollars, then we know that whatever we have left is our profit, okay? And it makes it much easier because we're not sitting there going, oh my goodness, it's like, how are we going to make payroll this week? Because we made all these sales back here, but we haven't collected anything on it. You with me? That gets pretty tricky when you are in an accounting department, okay? And we're offering sales on credit, okay? All right, so how do we estimate and report the effects of uncollectible accounts? All right, so the first thing, here's one of the great things. We're only going to actually learn one new journal entry. So think about what's happening here. You've seen that journal entry before, right? We made a sale on credit, okay? And sometime in the future, we've called and called and called. We've sent notices, whatever it might be. But sometime in the future, we actually figure out when, the bad debt. Now, during the same period in which we actually have to record that bad debt, okay, because again, remember, this is an estimate, right? We've now got to make that recording. Now, here's another new account that we're going to look at in this chapter is this allowance for doubtful accounts. So just understand that when we make the estimate, remember, we don't know who is not going to pay. So we now have a contra asset account, just like accumulated depreciation, right? We've already looked at that one, right? And we've got another contra asset account, but now it's associated with accounts receivable. So maybe accounts receivable is sitting out there at $200,000, but we think $20,000 of that $200 is not going to be collectible. Then that now tells us that our net accounts receivable is now $180. You with me? So it's important for everyone to understand when they're looking at the financial statements is now when we've got this net receivable, that's the amount that we think is actually going to be collectible, not the gross receivables. Okay? So when we actually make that estimate, so we've made the sale during the period, at the end of January, we're going to make the estimate. So we're going to book the bad debt expense. That feels weird because it's hitting the income statement and now lowering our net income, and nobody's done a thing. You with me? Nobody's proven to us that we're not going to collect or anything else. We're just, based on experience, we know 1.5% is not going to be collectible. Okay? That's when we're booking it with the allowance. Okay? So now, when this estimate gets made, net income goes down because the expense goes up, and think about this one, net assets decrease because we've now booked this contra asset. Okay? So that's when all the changes occur, is when we make the estimate. I cannot repeat that more often, because somebody's going to have a problem with that. Okay? All right. Now, sometime in the future, when we figure out who, so don't miss this, when we make the estimate and we don't know who, we just book it, hit the income statement, hit the balance sheet, and we go on with it. Sometime in the future, and let me just tell you, this could be a year, 2 years, 3 years down the road. Okay? We figure out who, we are now going to remove that the actual accounts receivable off the books, and now we go, aha, we know who we made that allowance for, and we reduce the allowance for doubtful accounts. Okay? So this is the same loop that we're going to go through every single month. We make the sales, we estimate the bad debts. Sometime in the future, we figure out who's not going to pay. Okay? All right, so when we've got so this is what we call the allowance method. All right, so we estimate the bad debts at the end of the period, and then when we actually know who, we remove or write off the accounts receivable. All right, so let's go back here. This is when we make the estimate. This is the write-off. Okay? It's important to make the distinction between those two journal entries because we could ask you for one or the other. So make sure you're clear on which one we're looking at. All right? So let's take a look at this one. So assume that VFC estimates $900 in bad debts at the end of the accounting period. Now, one of the things, if you're not keeping up with watching the lectures online, your call. But who is VFC? Do you know? It's Vanity Fair Corporation. You ever heard of that? Vanity Fair, one of the things you would probably recognize is there is a Vanity Fair magazine. Okay? But they are all about fashion and magazines and all that kind of stuff and everything. Do you know where their headquarters is? Greensboro. Okay? So, local company here for us. All right? So, assume that Vanity Fair Corporation estimates $900 in bad debts at the end of the accounting period. So, again, remember, we're making the estimate. So, we don't know who. We just know that not all of our sales or revenues are going to be collectible. So, we increase the allowance, which now reduces net accounts receivable. And we increase the expense, which now reduces net profit. Okay? All right? So, again, there is the original sales. We had $120,000 in revenue. Okay? We booked the accounts receivable. Now we're making the estimate, booking the allowance and booking the bad debt expense. So, look what happens here. When we're looking at this is sort of a cumulative balance sheet here. So the total accounts receivable is $200,000, which by default means that we've got, what, $80,000 from prior sales that are still outstanding. Out of all of this $200,000, we're saying that $15,000 of it is not collectible, which means we think $185,000 is the collectible amount. Okay. Then over here on the income statement, we're showing $120 in the revenues for this month, and we're showing $900 in bad debt expense for this month associated with that $120 in revenues. How we doing? Okay. All right, so VFC decides to write off an $800 receivable from Fast Fashions because the company could not pay its account. Okay, now, I want to make sure that you're clear on what's really happening here. In the book, it feels like, to me, that it's like we look at, an account like Fast Fashions and go, oh, well, I guess they're not going to pay, and we just write that bad boy off. No. Okay? We have sent letter after letter after letter after letter after letter, call after call after call. It is months overdue, if not a year overdue, and they have finally contacted us and said, we got nothing. We're not going to be able to pay. Okay? So don't look at this transaction and think, oh, okay, well, we just write it off and, just because somebody's a little bit late. No. Okay? So we book. We actually are writing off. So we reduce the accounts receivable by $800 and we reduce the allowance by $800. Now, I want you to think about this one. With this journal entry, what happens to net assets or net receivables? Does the balance change? Okay, but that's when net receivables changes. When we make this journal entry, does net receivables change? We're reducing accounts receivable and we're reducing the allowance. I know you want to say yes. The answer is actually no. Okay? Think about, well, let's keep going because we're going to look at it right here. Okay, so notice what happens here. Before we made the write-off, okay, we had $200,000 right here, right, as our balance. We also had 15 in the allowance. All right, now think about that one. If we've got 200 minus 15, that's a net receivable of the 185, right? We talked about that, right? Now watch what happens. If we do the write-off, watch what happens. The accounts receivable now reduces to 199.2, but what also happens is the allowance for doubtful accounts now goes down to 14.2. So now we're taking a smaller number and subtracting a smaller number, which gives us $185. So prior to the write-off, we've got a net receivable balance of $185. After the write-off, we have a net receivable of $185. Because we're reducing the accounts receivable by exactly the same amount that we're reducing the allowance. You see it? Okay? Remember I told you, this feels weird, right? You want that balance to change so much because now you're thinking, well, now we know who, and now we're writing something off, and now we feel like something ought to change. No. All the changes occur in the net receivables and the income statement when we make the estimate, not when we make the write-off. How we doing there? Okay, so that's the process every single time. We make the sale, we make the estimate, sometime in the future, we actually have the write-off. Okay? Now, there's two methods that we can use to make the estimate. Okay? So the 3 journal entries don't change. What changes when we're looking at these different methods is we're changing how we calculate the number. Okay? So, one, as a quick and easy, we've got a percent of credit sales method. Again, that's when I've been sitting there saying, we know, 1%, 1.5%, 0.5%, 3%, whatever it might be. Okay? Because that's super easy. We just take the percent and look at the amount of credit sales for the period and make the calculation, and boom, we're ready to rock and roll. We got the number to go into our estimate journal entry. Okay? We also have another one called the aging of accounts receivable method. This one is a little more work, but we're going to look at it to make it simple. All right? So, here's your percent of credit sales. We had $120,000. Remember, we're still working through the same problem, so nothing's changing. We've got the $120,000 in credit sales. So understand this. One of the things that you've got to be careful of is when you are looking at a problem and it says total sales for the month were $200,000. Credit sales for the month were $120,000. To make this estimate, we use the $120,000, not the $200,000, because we are making sales both with cash and on credit. And what's the collectibility of a cash sale? $100%. Because we're not letting them out the door without them paying, right? You with me? Okay? So be careful with that one when they give you total revenue numbers versus credit sales numbers, or they give you a total sales number and a cash sales number. Make sure that you're backing into credit sales. Okay? Those are the only ones that we have collectability problems with. So in this particular case, we've got $120,000 in credit sales this month. We've got bad debt loss rate, and that is 0.75%. So let's go back to middle school math. Here's the one thing that it absolutely kills me, so please don't do this to me, okay? Because when you convert 0.75% into a decimal place, make sure that you move your decimal enough places, right? So we move it 2 places, effectively multiplying it by 100, right? So be careful there, okay? Because sometimes somebody will look at 0.75 and they will move the decimal place to the right, and they'll take 120,000 times 7.5 or 0.075 or something like that. That's 7.5%, not 0.75%. Okay, so don't do that mistake. That's another one where we would both sit there and go over it during an exam and go, "Oh, I knew that." Okay, I know you did. Okay, just be careful. Slow down just a little bit when you're doing this. Okay, then you've got bad debt expense this month, right? So that's just 120,000 times the 0.75%. We got $900 in bad debt expense. Okay, that $900 is the number that we put into booking the bad debt expense and increasing the allowance for doubtful accounts. So again, net receivables is decreasing when we make the estimate. Net income is decreasing when we make the estimate. Okay. All right. So there you go. There is your journal entry. Okay. So how hard was that? Pretty simple. All right. Now, let's look at the aging of accounts receivable. Okay. Now, don't let all the verbiage and everything throw you off on this one. Here's what's really happening real world when we're looking at the aging of accounts receivable method. We basically, remember, all this stuff, there's all this data that is sitting behind that accounts receivable number, okay? And it's basically, here's the accounts receivable total, and out of that total, here's all the vendors down the first column, and here are all what we call the aging of all those receivables. And we just sort of look at this report and we can see like 0 to 30, 30 to 60, 60 to 90, and over 90 days. Once something hits over 90 days, your chances of collecting it dramatically drop, okay? So all we're doing is we're looking at this report, and instead of coming up with a percent of what we think is not going to be collectible, we're coming up with a number that we think is not going to be collectible, okay? So let's look at an example. So in this particular case, this total accounts receivable would be 208. That's what's sitting in your general ledger account in accounts receivable, okay? So this report matches that accounts receivable number on the ledger, okay? Out of that 208, 120 is 0 to 30, 45,000 is 31 to 60, 37 is 61 to 90, and we got 6,000 over 90, okay? Now, based on experience, we know, based on our data analytics and all that kind of good stuff, we know what percent of each one of those groups is not going to be collectible, okay? So look at what's happening here. Out of that 0 to 30 days, 1% of that is not going to be collectible, which basically tells you that this company thinks that out of all sales, 1% is not collectible. Does that make sense? Okay. Now, once all of these invoices, if they roll over to more than 30 days or 31 to 60 days, the chances that we are going to collect it drop to 90%. You with me? So 10% are not going to be collectible. Once it rolls over to 61 days, now our ability to collect it becomes 80% or 20% not collectible. Once it rolls over to 90 days, our chances of collecting it are at 60% or 40% of everything that goes over 90 days is not going to be collectible. How are we doing? Okay, now, real world. Increase these factors by 2. Because once it rolls over to 31 days, it's probably more like a drops to, or increases, the uncollectability increases to 20%. This one's more like 40 and this one's more like 80%. So how motivated are we to get these invoices collected early? Really motivated. No, it's all, good question. It is all about the date that the invoice was sent. So it's like if we're looking at like a January 1 invoice, that's the date on the invoice. Once it gets to the end of January, it's already 30 days overdue. Once it hits February 1, we're already at 31 days. So we're hoping that it's like if we bill it on January 1, we're going to collect it during January. How we doing? Okay. So here's our uncollectible estimates. Okay. Now, all we do is we determine 1% of the 120 is 1,200. So out of that column, 1,200 of that column is not going to be collectible. Once we roll over to 31 to 60, 4,500 is not going to be collectible in that one. 7,400 in the 61 to 90 and 2,400 in the over 90. Okay. So basically what we're saying is based on these percent estimates, we're trying to get to the number that we think is not going to be collectible. So out of 208, we analyze this report, do our math, we're estimating that 15.5 of that 208 is not going to be collectible. So again, that's our estimate. All right, you with me? All right, now, here's the deal. That 15.5 is, and you got to hear me on this one, that 15.5 is not the number that goes into the journal entry. Okay? So on the previous method where we just simply took the amount of revenues or credit sales times the percent, that number goes right straight into the journal entry. Not in this one. That 15.5 is going to be the ending balance in the allowance account. So now we got to look at the allowance account and figure out what's already there. How we doing? So the 15.5 is the ending balance in the allowance. Now we have to look at the allowance for doubtful accounts balance. It's currently at 14.2, so we need an adjustment amount of how we doing? The 1,300 is the amount that goes into the estimate journal entry, where we increase the allowance and increase the bad debt expense. How we doing? Okay. All right, so just simply preparing the journal entry, there you go. There's your bad debt expense going up. Here's your allowance going up. And what's happening to net assets after we make this journal entry? Good, it's going down. Because think about what's happening here, okay? Go back to, at some point y'all are going to go, oh, I got it. All right, let's see, hang on. Where's the T accounts that I'm looking for here? I know they're in here. Hang on. All right, hang on. I'm apparently a little farther back than I thought. Hang on. There we go. All right. Again, remember, when we're making the estimate, right, we're increasing the bad debt expense, which means expenses going up, net income's going down. We're increasing only one side of this two-number calculation, right? Because now we're increasing the allowance for bad debt or allowance for doubtful accounts, same account, okay? We're increasing the allowance, but we're not doing anything with the accounts receivable. You see that? So when we make the estimate, the accounts receivable balance isn't changing, but the allowance balance is going up, which means net receivables is going down. Okay? So then so when we make the estimate, that's when all the changes occur. Net income's changing, net receivables is changing. When we make the write-off, nothing's changing. Net receivables is not changing because accounts receivable and the allowance are changing by the same amount in opposite directions, which then makes it not cancel itself out. How we doing? I'm telling you, it feels weird. I get it. Okay? All right. Okay. So, other issues. Okay? So, follow me on this one. All right? So, when we're sitting there and we're making all these estimates and everything, currently we were making an estimate at, 0.75%. Okay? When we did the percent of credit sales. Here's the thing. Remember that we're making these estimates based on the past. So when we did all of those calculations and everything, we did a really nice analysis of what had happened in the past, and we said, okay, 0.75%. That's it. That's the number. Okay? But sometime in the future, maybe the economy is not doing as well as we thought it would continue doing. Or a pandemic hits. So now we've made estimates with under a certain paradigm and under a certain assumptions, but now something bad happens. Or something good could happen. Maybe the economy's doing better than we thought. Maybe, Who knows? Okay? It could go in either direction. But keep in mind that that whole process that we went through to make that estimate was an estimate. It's effectively an educated guess. But again, what did I tell you about our crystal ball in the accounting department? It's not all that great. Okay? And sometimes we miss something that could happen in the future that we just haven't anticipated. Okay? So when we are adjusting or revising estimates, it's not a problem. Okay? We'll look at if you get into intermediate accounting, that's when you will start looking at the whole detailed process of what happens when an estimate changes. Okay? But it's okay. We just simply, in the month in which we figure out that the estimate has changed, we start using the new number and we just move forward just like nothing's happened. Okay? It's actually a pretty easy way to deal with things. Okay? Then we've got this other process that we've got is account recoveries. Now again, in the book, it kind of makes you think that it's like, oh, we're writing it off and recovering it, writing it off, recovering it. No. We typically are writing stuff off when we think that it's like, yep, no, we're not going to get it. Okay? An account recovery, I'll give you an example of an account recovery. So when I first got to Charlotte back in the late 90s, I went to work for a construction contractor. And one day we're sitting there and my accounts receivable clerk comes in and she's like, okay, we got this check. It's made out to us. It's from the clerk of court for Mecklenburg County. And it came with this letter. And I have no idea what this is because the company name that's on this letter from the clerk of court, I don't even have it in the system. I was like, fun. I like free money. So I take the check and the letter and I do my own little bit of research in the system. She was absolutely right. There was nothing at all in the system. There was no, customer number or anything in there with this company name in it. So I go to one of the owners of the company, and I'm like, name of this company look familiar to you? He looks at the letter and he's like, oh, yeah. We wrote that account off, I don't know, like 3 years ago. They went bankrupt, and we just said, yeah, whatever. We're not getting any of that money. And they completely wrote off the account. 3 years later, when that bankruptcy actually finalizes, we actually get a check for pennies on the dollar of what they actually had owed us, but they did owe us that money. Okay? Then we've got an account recovery. Okay? So it's not quite so simple in the book as the book makes it seem, and we don't do it very often. We don't want to do it very often. So the first thing that we have to do is effectively reverse the write-off or get that accounts receivable back on the books. And look at what happens here. We're now increasing the allowance back up for the amount that we just recovered. Okay? So effectively, the reason why we increase the allowance back up to what we just received is now we're sort of have the idea that it's like, oh, well, we thought it was going to be them, but it's not. It's going to be somebody else. Because we still believe that our estimate is solid. Okay? Then the second journal entry is recording the collection of cash. Okay? So we simply get the accounts receivable back on the books, increase the allowance, and then collect the cash. It has to be done, by the way, in 2 journal entries, because when you're looking at it and they say, reverse the write-off, give me the journal entry for the reversal, give me the journal entry for the collection, it has to be broken apart into 2 journal entries. If you try to combine this together, and yes, I get the fact that it's like effectively what's happening here is accounts receivable is netting to 0. If you attempt to do it that way, it's going to mark it wrong. Okay, so just be aware of that. Okay, how are we doing? All right. So, interest on notes receivable. So, the reason why we have this notes receivable in the same chapter as these bad debts is this. Number one, we really don't want to write off accounts receivable for one very specific reason. Remember, that is top line revenue on that income statement. So now think about the fact that it's like, let's say that, let's say we had a 10% gross profit margin. You with me? If we have a 10% gross profit margin, every time we make a sale of $100, we make $10. You with me? If we write off $1,000, think about how much more in sales we're going to have to do to actually just break even. You following me? So we don't want to have to write off accounts receivable. Okay, that is a downhill quick situation. So sometimes what will happen is a customer will come to us and say, hey, we're really having some tough financial problems and everything. We really want to pay our bills, but we need extra time to pay it. We can't do the 30, 60, 90-day thing. And before we write off any accounts receivable, we're going to say, okay, what do we need to do here to make sure that we get that money collected? And what we will do sometimes is we will switch this over. We will roll that accounts receivable into a note receivable. And now when it rolls into a note receivable, now we're going to start charging them monthly interest. And we're going to come up with a payment plan. You with me? Because we do not want to have to write that money off. Okay? So we're going to have a promissory note. We're going to have maturity dates. We are going to have a interest rate charge. So now we have to calculate interest. Okay? So the principal is the amount of the note, which would be the old accounts receivable. We're then going to multiply that by the annual interest rate. Don't miss that one. That's always annual. And then the time. So if we've got 1 month's worth of interest that we need to calculate, we can just simply say principal times interest times 1 over 12. Okay, so that's the way that they play with it in the book. All right, so let's look at a couple of examples here. So no matter what, on each one of these notes, we've got $100,000 each. We got a 6% interest rate, and again, that's annual. The first one matures in 2 years. So if we're trying to calculate a year's worth of interest at a time, right, then we're going to have $6,000 of interest each year for 2 years. So in total, we're going to make $12,000 on that note. Okay. The second one, we're still at 6%, but it's due in 10 months. So we simply take the 6%, multiply it by 10 over 12, and that gets us $5,000 in earned interest over that 10 months. And then if it matures in 2 months, there's our 2 over 12. How we doing? Now, that's the way they do it in the book. I like consistency. Okay? So if I were you, here's what I would do. I would take the principal times the annual interest rate, force yourself to divide by 12 to convert that interest number into a monthly number, and then it makes you stop and think, how many months do I need? So if I need 3 months, multiply it by 3. If I need 5 months, multiply it by 5. If I need a month and a half, multiply it by 1.5. You with me? Okay. So just a little bit of simplification on that. And now that you've got a consistent monthly dollar amount for the interest, whether it's being earned, and in a later chapter we're going to look at being incurred when it's notes payable. Now that we have a consistent monthly number, now, one, it forces us to go that extra step to determine how many months we need. And now you don't have to go back and recalculate again and again and again and again and again by using the fractions. Okay? You just take X, X number of dollars per month times number of months. All right, so let's take a look at this example, okay? We got 4 key events that occur, all right? So the note is created on November 1 of 2024, all right? This particular note is due, the interest and the principal payment is due on October 31 of 2025. So it's how long? How long is this note? $12 months. You see it? The note was created on November 1 of 2024. It matures on October 31 of 2025. It's 12 months, okay? Now look at what happens here. The big issue in this whole little section is those notes are never going to line up perfectly with our financial statement dates, okay? So in this one, they start with a really simple example. So if the note was created on November 1 and our next financial statement date is December 31, then in this particular case, we've earned 2 months worth of interest that we are due. You with me? So in that particular case, we would need to put or accrue 2 months worth of interest onto our December 31 set of financial statements. So even though we haven't collected it, we've earned it, right? And revenues are recorded when they are earned. Okay? Then, once we roll over into the next year, okay, let me just say that in this particular part of the book, it's like we have hired the worst accountants ever. So just follow me for just a moment. So in this one, we go from December 31's financial statements all the way to October 31. Now, a lot of times in this part of the book, they literally will just skip January through October, January through September's financial statements, not book anything as being earned, and then suddenly we will hit it in one large lump sum in October's monthly financial statement, okay? But we got an issue here. We've submitted March 31 financial statements, June 30 financial statements, September 30 financial statements that are missing information. You with me? So be careful on some of this kind of stuff. Don't necessarily think that the book is real world. All right, so let's take a look. So assume that on November 1, 2024, VFC lent $100,000 to a company by creating a note that required the company to pay VFC 6% interest and the $100,000 principal on October 31 of 2025. All right, so that's all that's happened there. Now, we established the note receivable. In this one, we're actually pretending like we wrote them a check for cash. Typically not the case, but that's all right. All right, so there's the establishment of the note. All right. Then we've got the first entry that we've got to do is we've got to accrue interest on December 31 because we now have earned $1,000 in interest for the last 2 months, or $500 each month in November and in December. All right. So at the end of the year, we book the interest revenue and the interest receivable. Okay? Pop quiz. You ready? Where would this interest revenue go on a multi-step income statement? Beautiful. Non-operating income, right? Because we're not in the business of loaning money to our customers. Okay? Good. All right. Then, recording the interest received. So again, notice what's happened here. It's like we've just flown right over January through September, and we have now calculated the whole entire year's worth of interest that we are going to collect, which is the $6,000, plus we're going to collect the $100,000 in, which they don't put in here, so watch what happens here. So I like to change this one just a little bit, because again, it drives me crazy when they don't do real world stuff, because quite honestly, I don't want y'all showing up at somebody's office and somebody looks at you and goes, "Who's your accounting instructor?" The amount of cash that we're actually going to receive is 106. And what happens here is the note receivable goes away. Okay? They're going to do it in two different steps. They're going to treat it in this one like all they sent us was a check for $6,000 paying, settling up the interest, and then they're going to have a second one where we're settling up the note. Not really real world. Okay? How we doing? Oh, so I shouldn't have touched it. Okay, because here, bless you, is where you're actually collecting the note in this scenario. All right, now let's go back to this journal entry. So think about what happened in December of last year, right? We booked that interest earned last year. Now, and we booked the interest receivable. Now, we're reducing that interest receivable back down to zero because that was earned last year. Now, the interest revenue that is left when we collect that $6,000 total is now going to reflect the interest revenue number that we actually earned this year. Okay? Any questions on that one? We're going to get into some when we do the practice and stuff. We're going to get into some that it's like, boy, they really throw you a couple of curveballs. So, all right. So then we're going to compute and interpret the receivables turnover ratio. All right. So the receivables turnover ratio. Remember, turnover ratio means we're going to actually have a second step in there. So watch what happens here. So on the receivables turnover, at the point of selling where we invoice it to the point of collection is what we are evaluating here. Okay, so we bill that customer, we send it out, and now we're going to evaluate how long it's going to take to get that money back in. So we've got the turnover ratio. Remember that works just like any other turnover ratio. If we go to a turnover ratio of 12, we're collecting every month. If we get a turnover ratio of 26, we're collecting every 2 weeks. If we get a turnover ratio of 4, we're collecting every 3 months or every quarter. You with me? Okay. So remember, these turnover ratios work exactly the same. Then we can take that turnover ratio, divide it into 365, and get, on this one, it's called days to collect. All right. So notice what happens here. This is another one of those where it's like this formula looks a whole lot easier, but has a lot of numbers that are involved here on this calculation. So remember, net sales revenue. If we're talking about net sales, go back to your multi-step income statement. Net sales starts with, not yet, net sales. Net sales. Don't you hate accounting? You can't forget anything. Starts with sales revenue minus returns and allowances minus discounts. Sounding familiar? Remember, that's your internal multi-step, the top of your internal multi-step income statement. So don't forget that one. You got total revenues minus returns and allowances minus discounts, okay, gets you to net sales revenue. So that net sales number there at the top is now 3 different numbers from your accounting records, okay? Then from your income statement, okay? Then you've got your average net receivables. So again, now we've got beginning net receivables. So now it's accounts receivable minus allowance for doubtful accounts gets you net receivables. You with me? So now we've got to calculate that based on the beginning net receivables plus the ending net receivables divided by 2. So it's a simple average, at least that, right? So now at this point, we've got $500,000 in net sales revenue divided by average net receivables, which means we're collecting 10 times per year, okay? If we take that 10 and we divide that into 365 days, that means we are collecting every 36.5 days. Okay? How we doing? Yeah, you got to practice on this. Okay? So, think about this one. If everybody, now let's take this a step further. So hopefully it'll help you sort of solidify some of this. Let's say that we're collecting every 36.5 days. And every invoice that goes out to every single customer that we are doing business with says that our invoices are due net 30. Are our customers really paying attention to our due dates? To our terms? You with me? So every invoice that goes out, there's a date that the invoice is billed, and then there is a line across the top of the invoice, pretty standard, and one of the things on there says terms, and our terms are net 30. But we're on average receiving it every, not net 30, but every 36 and a half days. Are our customers paying attention to our terms? Not really. Not by like a week. Now, if we came up with maybe our terms were net 45 and we were receiving every 36 and a half days, are they paying attention? Yeah, they're actually being really great. They're actually paying us a tad bit early. How are we doing? Okay. All right. So, all right. Let me do this one and let's talk about. Then we'll take a break. All right. So let's take a look. So we got Vanity Fair Corporation, we got Post, and we got Apple. Now, remember, Vanity Fair Corporation, all about fashion, magazines, all that kind of good stuff. Who's Post? Good. They do cereal. So like, what is it? They do, is it like Captain Crunch, I think? But they've got a couple of cereals you've probably eaten, versus like General Mills, right? They do like Cheerios and stuff like that. Okay, but we're talking about cereals. And who's Apple? They do technology, right? Okay. Now, here's my big beef here. Can you actually take these 3 companies and compare them to each other? Why not? Okay, so we've got a size issue going on. Good. Completely different industries. So if we wanted a good comparison to Apple, it might be Microsoft. If we wanted a good comparison to Post, it would be General Mills. If we wanted to compare to, I don't know, Vanity Fair Corporation, I don't know. Not big into fashion, but maybe Vogue or something. Maybe. You with me? So remember, when you get, I want you to send me an email sometime later when you get to your senior level class. I want you to say thanks. I remember that class. So remember, you can't compare these because they're size is completely is a good issue. Completely different industries and everything else. Remember that when we're doing these comparisons, we're doing internally year over year, probably for the last 3 years. Then we're going out to our immediate competitor, and then we're even going out to the whole entire industry. So maybe under Apple, maybe we do Apple, Microsoft, and Dell. Okay? So let's look at VFC. So VFC, Vanity Fair, their receivables turnover is 8.5 times per year, every 42.9 days. Again, we can't really tell you whether or not that's good, bad, or indifferent because we don't know what's going on in the industry. We don't know what their competitors are doing. Okay. Post, we've got 11.8 times per year or every 30.9 days. That I can probably, when I sit there and I think about it, anybody work at like a Harris Teeter or grocery store or anything? How often do the trucks come in and how often do they stock? Okay, so getting paid every month or roughly once a month, that probably works. Okay, and then you've got Apple. And their days to collect is 25.2. Now, just realize, though, that in this one, this is probably a little shorter for a few different reasons because they're selling in 2 different markets. You've got the consumer market where they're selling directly to people like us. And when they sell directly to people like us, they're not going to let us out the store without payment, right? But if they are selling to other companies, right, that's probably going to take a little bit longer. So this could be skewed a little bit by the fact that it's like they actually sell to consumers and they're going to demand money when we leave. Okay? All right. Let's take a break. Let's be back in here.